technical analysis. In this lesson, we will learn about the assumptions of technical analysis, techniques of technical analysis, the Dow theory and Elliott wave principles, the candlestick approach, the market trends, and the difference between fundamental and technical analysis. After going through this presentation, you should be able to define technical analysis, explain Dow theory, describe trends, analyze Elliott wave theory, define candlestick approach, discuss the market trend, identify the difference between fundamental and technical analysis. Technicians, also known as quantitative analysts or chartists, usually look at price, volume, and psychological indicators over time. They are looking for trends and patterns in the data that indicate future price movements. Technical analysis is the attempt to forecast stock prices on the basis of market-derived data. This theory was first stated by Charles Dow in a series of columns in the WSJ between 1900 and 1902. Dow and later Hamilton and Rear believed that market trends forecast trends in the economy. A change in the trend of the DJIA must be confirmed by a trend change in the DJTA in order to generate a valid signal. Dow theory trend are divided in three parts. First is primary trend, called as the tide by Dow. This is the trend that defines the long-term direction up to several years. Others have called this a secular bull or bear market. Second is secondary trend, called as the waves by Dow. This is a shorter term departure from the primary trend, weeks to months. And third is day-to-day fluctuations. It is not significant in the Dow theory. The main movement, primary movement or major trend may last from less than a year to several years. It can be bullish or bearish. The short swing or minor movement varies with opinion from hours to a month or more. The medium swing, secondary reaction or intermediate reaction may last from 10 days to 3 months and generally retraces from 33% to 66% of the primary price change since the previous medium swing or start of the main movement. The purpose of Dow theory is to check or monitor the signal changes in the primary direction. It must also monitor two indexes. One, Dow Jones Industrial Average, and the other is Dow Jones Transportation Average. If one index departs from the primary direction, this is not a signal. However, if a departure in one is followed by a departure in the other, this is viewed as confirmation that the trend has changed. An upward trend is broken up into several rallies, where each rally has a high and a low. For a market to be considered in an uptrend, each peak in the rally must reach a higher level than the previous rally's peak, and each low in the rally must be higher than the previous rally's low. A downward trend is broken up into several sell-offs, in which each sell-off also has a high and a low. To be considered a downtrend in Dow terms, each new low in the sell-off must be lower than the previous sell-off's low, and the peak in the sell-off must be lower than the peak in the previous sell-off. Dow theory identifies three trends within the market: primary, secondary, and minor. There are three basic kinds of trends. First is an uptrend, where prices are generally increasing. Second is a downtrend, where prices are generally decreasing. And third is a trading range. Trend classification. First is trend length. A trend of any direction can be classified as a long-term trend, intermediate trend, or a short-term trend. In terms of the stock market, a major trend is generally categorized as one lasting longer than a year. Second is trend line. It is a simple charting technique that adds a line to a chart to represent the trend in the market. A channel or channel lines is the addition of two parallel trend lines that act as strong areas of support and resistance. R. N. Elliott formulated this idea in a series of articles in the Financial World in 1939. Elliott believed that the market has a rhythmic regularity that can be used to predict future prices. The Elliott wave principle is based on a repeating 8-wave cycle, and each cycle is made up of similar short-term cycles. Elliott wave adherents also make extensive use of the Fibonacci series. A candlestick chart is an extended version of the high-low close chart. It plots the high, low, open and closing prices, and also shows whether the closing price was above or below the opening price. White candle represents bullish pattern and black candle represents bearish pattern. Longer the body of the candle, there may be more implication of bullish or bearish pattern. Moving average charts are average daily prices or index levels calculated using a fixed number of previous days' prices or levels updated each day. Because daily price fluctuations are smoothed out, these charts are used to identify trends. The three most common types of moving averages are simple, linear, and exponential. Simple moving average is the most common method used to calculate the moving average of prices. This type of criticism has been one of the main factors leading to the invention of other forms of moving averages. Linear weighted average indicator is the least common out of the three and is used to address the problem of equal weighting. Exponential moving average (EMA) calculation uses a smoothing factor to place a higher weight on recent data points and is regarded as much more efficient than the linear weighted average. Moving averages are used to identify current trends and trend reversals as well as to set up support and resistance levels. Moving averages are a powerful tool for analyzing the trend in a security. They provide useful support and resistance points and are very easy to use. Moving averages help technical trade. A moving average is simply the average price, usually the closing price, over the last n periods. They are used to smooth out fluctuations of less than n periods. A doji is formed when the open and the close are the same or very close. The length of the shadows is not important. The Japanese interpretation is that the bulls and the bears are conflicting. The appearance of a doji should alert the investor of major indecision. The gravestone doji is formed when the open and the close occur at the low of the day. It is found occasionally at market bottoms, but its forte is calling market tops. The name gravestone doji is derived by the formation of the signal looking like a gravestone. The long-legged doji has one or two very long shadows. Long-legged dojis are often signs of market tops. If the open and the close are in the center of the session's trading range, the signal is referred to as a rickshaw man. The Japanese believe these signals to mean that the trend has lost its sense of direction. The bullish engulfing pattern is formed at the end of downtrend. A white body is formed that opens lower and closes higher than the black candle open and close from the previous day. This complete engulfing of the previous day's body represents overwhelming buying pressure dissipating the selling pressure. The bearish engulfing pattern is directly opposite to the bullish pattern. It is created at the end of an uptrending market. The black real body completely engulfs the previous day's white body. This shows that the bears are now overwhelming the bulls. The dark cloud cover is a 2-day bearish pattern found at the end of an upturn or at the top of a congested trading area. The first day of the pattern is a strong white real body. The second day's price opens higher than any of the previous day's trading range. The piercing pattern is a bottom reversal. It is a 2-candle pattern at the end of a declining market. The first day real body is black. The second day is a long white body. The white day opens sharply lower under the trading range of the previous day. the price comes up to where it closes above the 50% level of the black body. Hammer and hanging man are candlesticks with long lower shadows and small real bodies. The bodies are at the top of the trading session. This pattern at the bottom of the downtrend is called a hammer. It is hammering out a base. The Japanese word is takuri, meaning trying to gauge the depth. The morning star is a bottom reversal signal. Like the morning star, the planet Mercury, it foretells the sunrise or the rising prices. The pattern consists of a 3-day signal. The evening star is the exact opposite of the morning star. The evening star, the planet Venus, occurs just before the darkness sets in. The evening star is found at the end of the uptrend. A shooting star sends a warning that the top is near. It got its name by looking like a shooting star. The shooting star formation at the bottom of a trend is a bullish signal. It is known as an inverted hammer. It is important to wait for the bullish verification. Now that we have seen some of the basic signals, let us take a look at the added power of some of the other formations. A market trend is the direction in which a financial is moving. Market trends can be classified as primary trends, secondary trends, short-term, and secular trends or long-term. A primary trend has broad support throughout the entire market or market sector and lasts for a year or more. A bull market trend is to be associated with increasing investor confidence, motivating investors to buy in anticipation of future price increases and future capital gains. A bear market is a steady drop in the stock market over a period of time. It is described as being accompanied by widespread pessimism. A stock market bottom is a trend reversal, the end of a market downturn and the beginning of an upward moving trend. The key differences between fundamental analysis and technical analysis are: fundamental perspective is long-term in nature and is conservative in its approach, acts on what should be, but technical analysis outlook is short-term oriented and is aggressive and acts on what is. Fundamental adopts a buy and hold policy and does not usually expect any significant increase in the value of its investments in less than a year. Technical analysis believes in making a quick buck. Fundamental analysis forecasts stock prices on the basis of economic, industry, and company statistics. The principal decision variables take the form of earnings and dividends. He makes a judgment of the stock's value with a risk return, but technical analysis forecasts security prices by studying patterns of supply of and demand for securities. Technical analysis is study of stock exchange information. Tools used in fundamental analysis are financial analysis and statistical forecasting techniques, but technical analysis uses mainly charts of financial variables besides some quantitative tools. Now let us check if you have understood the various concepts discussed in this lesson clearly. Technical analysis is a method of evaluating securities by analyzing the statistics generated by market activity, such as past prices and volume. Right or wrong? Right. Technical analysis assumes that at any given time a stock's strong form reflects everything that has or could affect the company. Right or wrong? Wrong. Fundamental analysis is based on inadequate income statements and highly subjective nature of earning multipliers. Right or wrong? Right. Before we end, let us briefly revise what we have studied till so far. Technical analysis and fundamental analysis are the two main schools of thought in the financial markets. Technical analysis looks at the price movement of a security and uses this data to predict its future price movements. Fundamental analysis, on the other hand, looks at economic factors, known as fundamentals. The principles of technical analysis derive from the observation of financial markets over hundreds of years. Dow theory is based on the collected writings of Dow Jones co-founder and editor Charles Dow, and inspired the use and development of modern technical analysis from the end of the 19th century. Modern technical analysis considers Dow theory as its cornerstone. Rule-based trading is an approach to make one's trading plans by strict and clear-cut rules. Line chart represents only the closing prices over a set period of time. Confidence index is the ratio of a group of lower grade bonds to a group of higher grade bonds. When the ratio is high, investors' confidence is also high.